This module is on understanding cost behavior, and it introduces the concept of contribution margin. So when you finish this module, you should be able to distinguish between a variable and a fixed cost. You should understand the significance of what we call the relevant range. Now, some costs are partly fixed and partly variable. They're referred to as mixed costs. And you're going to have a model in this module that will help you break out the fixed and variable cost. And lastly, we introduce a very important concept. It's called contribution margin. And how do we calculate it? Now, to begin with, cost behavior analysis is a study of how specific costs respond to changes in the level of business activity. As activity increases, some costs will increase, others will remain the same. Now, understanding this helps management plan future operations and decide between alternative courses of action. So the starting point here is measuring business activity. So when we talk about business activity, we basically talk about sales dollars. If sales increases, which costs will increase, which costs will not. Or production. If I produce so many items, what production costs will increase and what production costs will not. But it applies to everything: room occupancy, dance classes, and so on. So we're familiar with that. Now, a variable cost is a cost that will change in total, indirectly, and proportionally with changes in level of activity. If sales levels increase 10%, total variable costs will increase 10%. If the activity level decreases 25%, the total will decrease, variable costs will decrease by 25%. However, on a unit basis, a variable cost remains the same. Let's take the production of my desk again. Let's just take wood. Now, let's say the wood, I know directly it's a direct cost, and it's 50. If I produce one desk, the total cost for wood is 50. If I produce two desks, the total cost for wood is 100. If I produce 10 desks, the total cost of wood would be 500. So you see, it is a variable cost because it changes in total, in direct proportion to changes in the level of activity. But it remains 50 on a unit basis. If I produce one desk, the unit cost for wood is 50. If I produce two desks, the unit cost for wood is 50. If I produce 10 desks, the unit cost for wood is 50. So a variable cost changes in total, but remains the same on a per unit basis. Take a minute and read this example, and you can see that a variable cost can be graphed in total as the graph on the left, or on a per unit basis as the graph on the right. Now contrast that with a fixed cost. A fixed cost remains the same in total, but the fixed cost on a unit basis goes down as activity goes up. Let's take rent. To produce my desks, I pay $10,000 a month in rent. If I produce one desk, the rent cost is $10,000. If I produce 100 desks, the rent cost is $10,000. If I produce 500 desks, the rent cost is $10,000. But on a unit basis, if I produce one desk, the cost per unit is $10,000. But if I produce two desks, the cost per unit is $5,000. If I produce 10 desks, the cost per unit is $1,000, and so on. You see, on a unit basis, a fixed cost decreases as the level of activity increases. And we can graph a fixed cost very easily. In total, it remains the same. However, as activity increases, the fixed cost will decrease per unit. So when I graph it, there you have the two graphs. Now, this brings in the idea, before that, variable costs are costs that what? Vary in total, directly and proportional as true. Remain the same per unit, that is true. So the answer here is both A and B. When we talked about fixed costs, we must bring in the idea of relevant range. When I talked about the rent being $10,000, that's $10,000, and I can probably produce up to 1,000 desks. But once I reach the limit of 1,000 desks, my fixed costs will jump because I no longer have the capacity to produce any more than 1,000. If I have to produce more than 1,000, then I have to add capacity in bigger area and so on. So we say that within a relevant range of 1 to 1,000 desks, the fixed cost will remain the same. Now, a mixed cost is partly fixed and partly variable. It will change in total, but not proportionally with changes in the level of activity because of the fixed portion. So we have to break it out. And to do that, we look at this. Let's first of all distinguish what are variable and what are fixed and what are mixed. So direct materials is 10,000 units, it's $20,000. But if I double production, the cost doubles, so it is a variable cost. Maintenance, it is 8,000 at 10,000. It changes, but it does not double, so it is a mixed cost. And a fixed cost remains the same. So you see in this case, maintenance and utilities are mixed costs, partly fixed and partly variable. So we use the high-low method here. We say the difference between the high activity and the low activity, the difference in the cost is related to the variable costs because the fixed will remain same. Let's take a problem. the formula here is the total change in cost divided by the change in activity between the high and the low will give me my variable cost per unit. So here we have Metro Transit, who have tracked the costs and the miles driven for 6 months. And they see you take the high activity, which is 50,000 miles, and the low activity, 20,000, and you take the costs, 63 and 30, and you get the change in cost over the change in activity, and therefore the variable cost is $1.10 per unit. So if I wanted to figure out what the fixed is, then I take the total and I multiply, I figure out of that total how much is fixed, 50,000 at the high, which would give me 55,000, and therefore the difference must be the fixed. The total variable cost at the low would be 22,000, and when I subtract that from the total cost, I get the same fixed cost. So that's the high-low method. Here's another example. We could write it as fixed 45,000 miles, the estimated maintenance cost then, fixed 8,000, variable 49,500. Now, variable income statement. What we're talking about here is this is an income statement for financial accounting purposes. You see sales, cost of goods sold, gross profit, selling expense, administration expense, and net profit. That's fine. That's how it reports our operations to people outside the business. But for our purposes, it doesn't help us as management decide what's going to happen in the future. What we do is we determine which costs of the cost of goods sold are fixed and which are variable, which are the selling expenses are fixed and which are variable, and what administrative expenses are fixed and which is variable. And we produce then what is called a cost volume profit income statement. Now, we haven't changed anything. The bottom line is the same. The net income, the sales are the same, except the expenses now are broken into those that are variable and those that are fixed. And we introduce a new concept here, the contribution margin. The contribution margin is simply the sales minus the variable costs. So in this case, the contribution margin is 320. Now that's not gross margin or gross profit, that's contribution margin. Sales minus variable costs, so get that straight. Now this contributes to the fixed costs. So I have 320, and these are my fixed costs, and I only have 200,000 of fixed costs, therefore my profit is 120,000. So now the terminology, when I talk about contribution margin, I'm talking about in total. I can also talk about the contribution margin per unit. The selling price was 500. The variable cost per unit, there were 1,600 units, and the variable cost is 480. So therefore, the variable cost per unit was 300. The contribution margin per unit is 200. And so, two new terms, contribution margin in total, contribution margin per unit, and this is a cost volume profit income statement. I have here cost volume, we have selling price 500, variable cost 300, mixed cost, fixed, total fixed 200, units sold. So again, my cost volume income statement shows this. And my contribution margin per unit is the unit selling price minus the variable cost. Contribution margin ratio, and that is the contribution margin per unit divided by the unit selling price, 500. Anytime in accounting you hear the word ratio, it's always a percentage of sales. So contribution margin ratio is the contribution margin as a percentage of sales. And there you have the